Welcome to this exciting update on one of the most important regulatory changes in the financial sector today. In January 2026, the International Financial Services Centers Authority (IFSCA) introduced sweeping changes to the capital market intermediaries regulations. These amendments are poised to reshape the landscape of how capital market entities operate in GIFT City. Whether you're a founder, a CXO, a board member, or a senior manager at an IFSCA registered unit, this video is a must-watch. You'll discover the key reforms, what's changed, and how they impact both existing and new units. We'll also outline the critical compliance steps you need to take now to stay ahead of the curve. Let's dive in and unpack what this means for you and your business. IFSCA didn't make these changes on a whim. These amendments stem from careful industry feedback after the capital market intermediaries regulations were first introduced in 2025. Let's explore the main concerns that drove these changes. Multiple registrations for multiple activities created operational inefficiencies. Rigid qualification and experience norms were limiting access to global talent. Duplicative senior management roles increased costs. Uncertainty in custodian capital requirements caused planning challenges. By addressing these pain points, IFSCA is positioning GIFT City to be more competitive, globally aligned, and innovative. The goal is clear: ease of doing business, integration of global talent, and strong practical governance. What was the earlier rule? Prior to 2026, if an IFSC unit wanted to operate as a broker-dealer, an investment advisor, and a distributor, it had to apply for 3 separate registrations. This meant separate compliance processes, separate principal officers for each increased operational costs. What has changed in 2026? IFSCA has introduced the concept of unified registration, meaning a single IFSC unit can now operate under one integrated registration for multiple capital market activities. Impact on existing units. For existing entities, this is optional. You can consolidate multiple licenses into one, reduce regulatory duplication, and simplify compliance and inspections. Impact on new units. For new units, both Indian and foreign applicants can now apply for a single registration, allowing for faster market entry and simplified corporate structuring. This is a huge step forward for integrated financial service models. Earlier, ruled previously, principal and compliance officers had to hold postgraduate qualifications in specific fields like finance, law, economics, or banking. The term recognized also applied to foreign degrees, creating some ambiguity. What has changed now? IFSCA has expanded eligibility to include qualifications in fintech, STEM fields, science, technology, engineering, mathematics, and removed the word recognized before foreign degrees. Practical impact. This is a significant shift, signaling that tech founders and STEM professionals can now lead regulated entities. It makes the industry more inclusive of global talent, especially for fintech-driven models. Earlier rule: if a principal officer had only a graduation degree, they needed at least 10 years of financial services experience to qualify for the role. New rule: now this experience requirement is reduced to just 5 years. Impact. This change opens the door for younger leadership, encourages entrepreneurship, and aligns IFSC norms with global standards. It's particularly beneficial for fintech startups and boutique advisory firms. Earlier framework previously, each registration required a separate principal officer, leading to unnecessary duplication. What is allowed now? IFSCA now allows an entity to appoint the same principal officer for multiple activities, such as broker-dealer, clearing member, investment advisor, and more. Business impact. This change reduces compliance costs, centralizes accountability, and aligns the entity strategically, especially for integrated financial service institutions. Why this matters? IFSCA has introduced a critical governance change. If an entity operates in multiple activities and one of them is distribution, they must appoint a separate head for the distribution function. Impact. This ensures dedicated oversight, strong conduct controls, and clear accountability, especially in broker-dealer, fintech, and advisory firms. Supersession of 2021 Circular. The earlier 2021 IFSCA Circular on Custodians has now been withdrawn, with all custodian regulation now consolidated under the Capital Market Intermediaries regulations. Net worth requirement. A minimum net worth of $1 million is now required for custodians, providing predictable capital planning. Transition period. Existing custodians have until June 30th, 2026 to meet these new capital requirements. Here's how the amendments affect different entities. Broker-dealers can consolidate licenses, appoint a single principal officer, and must appoint a distribution head if distributing products. Custodians must meet the new net worth requirement of $1 million and can share principal officers across roles. Fintech entities, STEM and fintech degrees now accepted, and the 5-year experience rule helps founders. Investment advisors, easier leadership qualification, and unified licensing options. Research entities, quantitative and tech backgrounds are now validated, with shared principal officer options. Distributors, distribution head is mandatory for multi-activity firms, but other rules remain the same. Here's what IFSC units need to do now. Review principal and compliance officer eligibility. Identify need for a distribution head. Evaluate unified registration opportunity. Custodians must plan capital compliance before June 2026. Update compliance manuals and governance frameworks. Align HR and recruitment strategies. Engage advisors for transition planning. The 2026 IFSCA amendments show one thing very clearly. Gift City is evolving into a truly global financial center. These reforms are designed to encourage innovation, reduce friction in operations, strengthen governance, attract global capital. For IFSC units, the opportunity is significant, but only for those who adapt early and comply intelligently. Thank you for watching, and we look forward to your success in navigating these exciting changes. Munses and Management Consultants LLP, a trusted partner for SEZ and IFSC Excellence, a pioneer in establishing SEZ and IFSC units within Gift City and India, delivering end-to-end IFSC setup, operational support, and handling complaints, risk management, renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university, BATF, and ancillary regulations, and fintech. Expertise in customs, clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA, comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network, scan the QR codes below to stay connected with us.